Has the market hit the bottom yet? Who knows? One thing that's clear is that we're seeing some real volatility in the market right now, with composites dipping in and out of bear market territory every time there's some negative news. This doesn't mean you have to watch your investments sink into the red, and it's not a great time to be selling your stocks either, which is just realizing your losses. Volatility presents a different opportunity for investors if you know how to take advantage of it. So I'm going to explain what moves I've been making to balance out my portfolio using leverage. Here we go. Whether it's news from the Fed, companies missing earnings, or world events, there is clear volatility in the markets right now, and whilst institutions try to predict the bottom, investment sentiment is falling. Whereas volatility is supposed to suggest ups and downs in the market, we are seeing a general decline, with the Dow down over 14% year to date, the S&P 500 almost 15%, and the worst hit of all, the Nasdaq is down almost 30%. If your portfolio was Nasdaq heavy, I imagine you're feeling the pain. Although it sucks to take a beating, I've brought up many times on my channel that many of these large cap companies needed a correction, and even though I've been avoiding these companies myself, sticking to companies with better fundamentals and more reasonable prices, my portfolio has also been hit. But I've said before I wasn't giving up on the market, and it's about time in the market, not time in the market, that wins long term. As long as you avoid idiot stocks, invest based on solid fundamentals, then you can get through this relatively unscathed. There are links below referencing videos I made on this subject. What I want to do in this video is explain some short-term strategies that can balance out the downward trend, take advantage of a crumbling market. To start with, there are 2 points I need to outline first: volatility and leverage. The market doesn't always go up, and anyone that thinks that is a moron.
You stupid idiot! You're fat, bloated, stupid idiot! Idiot!
Although this creates a contradiction when you buy stocks on the assumption that they will go up, but you have to accept that they can trend the other way, and even as a company trends upwards or downwards, it's never in a straight line. As frequently as I've been critical of Cathie Wood's ARK Innovation Fund, it's trended down 65.46% over the last 12 months, which might tell you I'm right, but taking a closer look reveals the ups and downs, and if you consider just the last month alone, it's up 8.61%. So just as good stocks don't always go up, bad stocks don't always go down. Now I don't need to cover the ups and downs of volatility, the buy low, sell high strategy, as this is pretty basic, but what you need to know about volatility is how it affects the true value of your investments. Stocks are not worth the market price, they are worth the sell price, and that is determined by the spread. That's the gap between the buy and the sell price, with the sell price always being lower and heavily influenced by volatility. The size of the spread is determined by the broker using 2 factors. The first is the daily trade volume, which is used to form an average price and determine a fair sell price. The higher the liquidity, the faster this is done, so the spread is smaller, whereas low liquidity results in larger spreads. The second factor is volatility, how much the stock moves in either direction. Massive stock moves represent a high demand to buy or sell. If you're holding a stock that has jumped up 25% in a day, you are less likely to care about a large spread if you can walk away with 75% of your gains on a high, because as much as you deserve that extra 25% more than the broker, holding out for a better spread risks missing out on the peak as other sellers cash out before you. Because chances are those sellers know that when stocks jump up by such a large margin, they are more likely to go down than up. Smart investors know that buying stocks riding a high because of superficial short-term sentiment is not a great strategy, and you're better off accepting that you missed this one than buying the high, only to watch it come falling back down as investors cash out and the stock returns to more rational levels, based on fundamentals of the company. Cathie Wood's history of buying speculative stocks at their peak, then trying to average out the losses by buying more as they continue to fall, is why the ARK Innovation Fund is such a disaster. The point is, your stock's only worth what you can sell them for, and even if the stock ends up higher, it's volatility that determines what you can sell them for. Based on this, you're likely to see a more efficient return on investment if you avoid volatile stock and instead buy stocks that are more stable, where the sell price is likely to be closer to the market price. But when stocks do show a period of volatility, there are ways you can make money from this. And to do that, you need to understand leverage.
If you only knew the power of the dark side.
We're crossing into day trading territory here, and you might be imagining traders with multi-screen trading setups using their knowledge of tactical chart patterns to make split-second decisions on live stock feeds from their top-of-the-range trading platforms. Sure, that's true if you want to be a full-time day trader, but it doesn't have to be that complicated. Whereas the US have the benefit of options trading, the primary tools offered to us in the UK through retail brokers are CFDs and leverage funds. And the main draw of these options that you won't get from regular stock buying is the option to bet against a particular stock or market composite. You can leverage your position, multiplying the value of the trade for a larger return on capital. This is especially relevant when even the best companies are trending downwards and the only traditional options are to watch your stocks plummet, sell and realise your losses, or buy more on the dip. Buying more is the more ideal solution, assuming you believe your stock will rise over the long term, but it's not ideal to use up your entire cash position in a market where they may continue to be trading downwards.
And it's gone.
So instead, using leverage options can offset your losses and build up your cash position. Of the UK options, I don't personally like CFDs, as I found the spread, being leveraged so highly, can move against the trader much faster than the broker, which creates a type of house always wins scenario. It's largely why the data suggests that around 76% of CFD traders lose money, whereas you can bet that the brokers make profit on 100% of transactions. Instead, I'm more inclined towards leverage funds, which, although operating with lower leverage values than CFDs, the spread doesn't work against you as much. Brokers offer different options, but the leverage funds I tend to use are Leverage Shares, Granite Shares and Wisdom Tree, which offer various long and short positions on equities, commodities and currencies, with leverage rates on 1, 3 and 5 times, each with their own pros and cons. The lowest one-time short position is the most common, and this is great for traders who think a company is generally going to decline over the long term, so want the benefit of a long-term short position without the pressure of higher leverage during volatile periods. Being on the wrong side of a 3 or 5-fold position is more than some traders can handle, and building your wealth on leverage is how Bill Hwang lost 20 billion in 2 days. But these highly leveraged positions mean you can make massive gains from short-term positions, which is useful when volatile stocks tend to show the largest moves within the first few hours of trading and settle down nearer the end, so you can make gains early when holding for extended periods of time presents bigger risks. But there are some rare occasions where long-term leverage positions are justifiable. Here's some practical examples.
Then words is all you have to do to make it real.
As you can see, I'd already set up a short position with ARK based on the latest market news and pre-market activity. So when the US market opened at 2:30 UK time, I was already able to ride the momentum. The stock initially moved up, which drove my position down, but I stayed with it, and with the news of inflation hitting the market, it dropped for the remainder of the trading session.
Hello, darkness, my old friend.
And gave me roughly 9% return on investment within 1 day. My trade with Nvidia on the bottom right is a similar example, but not one I play often, as Nvidia has been a slimy bugger and has too often traded the opposite way than I had expected. But knowing inflation was going to hit the entire market quite harshly, I made a move on this occasion and made a similar return on capital. Now, if I had been holding the stocks the day before, then I would have made almost 30% gain in a single day, but it's risky to hold these types of funds overnight. Leverage funds tend to revolve around companies driven by market sentiment and can be unpredictable and very volatile in the short term. UK funds can only replicate the US market until the UK market closes at 4:30, at which point the fund freezes and is reset overnight, so further activity on the US market is ignored and the fund restarts the next day with the pre-market trades. If the stock has moved against you by 4:30 but has moved in your favour by 9 PM, you've still lost out. And if the stock has moved to an extreme in either direction, it's quite likely to move the opposite direction the following day and you increase your losses. Also, as these funds amplify the stock price but work within smaller funds, they need to be reset if stocks rise or fall over a certain threshold. As with leveraged shares, if a stock rises or falls over 16.67%, they will process a large correction to rebalance out the fund. It's for this reason that the fund chart doesn't match their corresponding stocks and why it's best not to hold volatile positions overnight. Instead, I form my strategy based on overnight news and pre-market trades. This means a later entry point, but I'm more confident of where the stock is likely to move and willing to place a larger position for when the US market opens. However, note my position with BAE on the bottom left, which is an exception to the rule, as I've been holding for a while. The difference with this fund is that it's amplifying my long-term stock position, where BAE represents 7.66% of my portfolio. The leverage version is 4.98%, but gives me a threefold increase in return. Additionally, as BAE and the leverage fund trade on the London Stock Exchange, it's not affected by conflict in market time. Although BAE as a stock has shown some volatility, it is on a genuine climb. So even on the down days, I'm happy holding my position as long as I think the stock has not been priced in. And with the situation in Ukraine looking to continue for quite a few years, along with continuing tensions with China and Russia, we're not there yet. Now, I am planning to deep dive my defense stocks at a later date, so subscribe so you don't miss out. When it comes to dealing with the spread, note the brown line. This is the sell price that I place manually to track the price as it increases throughout the trading sessions. I don't move it down. This way I can track the highest sell price of the day, so I know volatility is working in my favour. But when the sell price starts to settle or drops below this marked amount, I know the stock position has likely peaked and I need to close my position, as the spread is now moving against me. There are many chart patterns you can read into, but the one most relevant in a short-term play is when you see a logarithmic or inverse growth curve like these. This suggests the volatility is settling down and your sell price is likely to settle close to the market price. The stock could continue trading sideways or jump in either direction, forming a standard or inverse cup and handle pattern, but those moves will add volatility and your sell price will fall to reflect this. Remember, with volatile stocks, the goal is to maximize your sell price and not to hold overnight. So if it's 4 o'clock in the afternoon and you're seeing this pattern, it's time to sell, as the last 30 minutes of trading is going to be very risky to hold. My strategy is not about maximizing gains, it's about using available data to form the lowest risk for short-term position, not overstaying and losing when the stock comes back down or volatility butchers my sell price, but recognizing when it's time to walk away with a reasonable return on investment. 15%, 9%, 5%, even a 3% return in a day is still beating the market by a massive margin. Remember, you only make money when you sell, and when it comes to holding out for more gains, bulls make money, bears make money, pigs get slaughtered. It's a tough time for investors when you're seeing your stocks take a battering, and I've seen many YouTube channels posting their various videos on how this is a crash, inflation is killing the market, it's all over, I'm selling my stocks, blah blah blah. These people are just cashing in on media news reviews. Whilst I promise you, I'm never going to be making those sort of daily videos because I'm too busy making money on my trades. If you really think the market is on a downward trend, that a particular stock is on a high and deserves a front and centre position in a market correction, then here's a way to put your money where your mouth is and make some money from their losses, rather than just being annoyed with your investments being in the red. Leveraging requires more micromanagement of your positions and regular stocks, and you need a disciplined investor mindset to tolerate the impact of volatility and your amplified position. If you make the mistake of leveraging a stock that's been pumped up due to market sentiment, not fundamentals, then you risk losing money at an alarming rate in a correction. There was a time when many investors were along with many large cap companies, which looked to be on a trip to the moon, but they have now collapsed under the weight of their overbought status, and the last thing you need with such a downfall is a fund amplifying your losses. For me, having spent considerable effort and time building a portfolio of good valued companies, I'm not about to sell my position at a loss, and I'd rather have the cash to hand to buy more at a later date. So taking out leverage positions mean I can bet against the companies I have repeatedly called overvalued and balance out the falls in my other positions. So I'll have more cash to hand to increase my long-term positions at a lower price when the market starts to settle down. So that's my take, and I hope you found it useful. I did want to go into more detail, but at the moment I'm struggling to justify the time spent making these videos when I'm not really getting the feedback from viewers as to what they want me to talk about. So if you have any thoughts, please comment below, let me know. And if you like what you see and you want to see more, smash that like button and subscribe so you don't miss out on future videos. Until next time.